Grant Mercer, and this is the pre-open edition of Storm Stock Solutions, where we try to bring a little clarity through the chaos before that opening bell rings. It's a quieter macro morning, but we do have a very clear focal point on the equity side. Another big move inside the AI ecosystem. According to reporting from MarketWatch, Nvidia is making a roughly $2 billion investment in Synopsys and tying that directly to a new strategic partnership around chip design software. Let's start there because that's the kind of deal that can shape sentiment at the open. Synopsys sits in a critical part of the semiconductor value chain, electronic design automation, or EDA. That's the software stack chip makers use to architect and verify advanced semiconductors. Nvidia writing a multi-billion-dollar check and deepening a partnership tells the market a few things. First, it reinforces the idea that AI isn't just about GPUs. There's a broader picks and shovels layer in design tools and IP that could see sustained demand. Second, it suggests Nvidia wants tighter vertical integration around how next-gen chips are conceived and optimized. Traders will be watching how both Synopsys and Nvidia trade on the headline. For Synopsys, investors may frame this as validation of its strategic importance and potentially a longer runway for growth in AI-driven design. For Nvidia, it's another sign of capital deployment into its ecosystem rather than just buybacks or dividends. That can raise questions about return on invested capital, but it also underscores management's conviction that this AI cycle has legs. Look for sympathy moves in peer EDA names and in broader semi and AI infrastructure ETFs as the open approaches. Now, away from the pure tech story, one of the more human-scale pieces trending this morning actually touches real estate and household balance sheets. MarketWatch has a widely read column about a family where a brother has fallen on hard times and a sister wants to buy his house, then let him live there rent-free while she handles the maintenance. Why does something like that matter for markets? Because these personal finance stories are a window into the pressure points across Main Street. Housing affordability, family-backed bailouts, and how people are using property to navigate financial stress. Investors in housing-related names often watch this kind of anecdotal evidence as a backdrop to the hard data on delinquencies, home equity borrowing, and local market resilience. The theme here is simple. More creative, family-based solutions can sometimes keep distressed supply from hitting the market, which can subtly influence inventory and pricing in certain regions. In terms of areas of strength, that family housing story really highlights a broader resilience in residential real estate as an asset class. Even when cash flow is tight, people are bending over backward to preserve homes and equity. Professionals looking at home builders, RIAs, or mortgage servicers may not trade off one column, but they will be asking whether we're seeing the early signs of stress or just isolated cases that the private safety net can handle. On the risk side, we don't have a clean sector under fire story in this batch, but there are a couple of watch list items where the market may be asking tougher questions. One is Airbus. Reporting from MarketWatch notes renewed issues around A320 aircraft, impacting thousands of planes and recently driving Airbus to its worst share price day in about a year. Anytime you see large-scale technical or safety-related concerns in commercial aviation, it raises potential ripple effects. Supply chain delays, airline capacity planning, and the competitive dynamic versus Boeing and other manufacturers. U.S. investors may not see Airbus headlines move futures directly, but they can feed into the narrative around aerospace reliability, maintenance costs, and delivery schedules, important for airlines, lessors, and parts suppliers. This is an area to handle with care until the scope and cost of the fixes are clearer. We also have a cluster of debt and liability-related personal finance stories that, taken together, sketch out another risk theme. There's a piece on a 41-year-old with 5 kids, $46,000 in credit card debt, and over $1 million in retirement accounts wrestling with whether to tap IRAs to get rid of that high-interest load. Another article digs into what happens when a co-signer on a BMW loan ends up on the hook after the primary borrower defaults. These aren't stock-specific catalysts, but they speak to the squeeze from consumer credit costs. For banks, card issuers, and autos, investors will be watching things like charge-off trends and how far households are stretching before something breaks. Let's talk sleepers, under-the-radar setups that I'll be watching as background themes rather than immediate trade calls. First, that laundromat inheritance story. Two sons set to receive $500,000 laundromat businesses from grandparents, with the family trying to ring-fence ownership from future spouses. On the surface, it's estate planning, but under the hood, it's about small, cash-generating, boring businesses that keep throwing off income. In a market obsessed with AI and streaming, investors sometimes underappreciate the role of mom-and-pop services in local economies. Professionals focused on small cap, community bank, or local services exposure may treat this as one of many reminders that private small business health is a pillar of U.S. consumption. Second, the Netflix Stranger Things angle. MarketWatch highlights that the franchise has already hauled in about $1 billion for Netflix, with the final season potentially adding hundreds of millions more. The bigger question is whether Netflix can turn it into a Star Wars-style, multi-decade universe. For streaming and media investors, that's the long game, not just hit shows, but durable IP that supports spin-offs, merchandise, games, and licensing. As December content slates roll out across Netflix, Hulu, Max, Disney Plus, and others, professionals will be parsing who has true franchises versus just hot series of the moment. Because the macro calendar in this specific feed is light, futures in the open may be driven more by stock-specific headlines like Nvidia Synopsys and by ongoing positioning into year-end, rather than a single economic print. As always, check your own data feed for any last-minute economic releases or Fed speakers that could surprise the tape. Into the opening bell, I'll be watching three things: the market's appetite for anything tied to the AI design stack after that Synopsys news, whether aerospace sentiment stabilizes after the latest Airbus issues, and how consumer credit and personal finance stress stories continue to show up in the data and in bank and retailer commentary. I'm Grant Mercer, this is Storm Stock Solutions, and we'll be back with intraday updates as the session unfolds. As always, this is information and education, not personalized financial advice.